Okay, everyone. I think we'll get started then. Thank you all for joining us for dv01's first co-presentation with a third-party data vendor. I'm your host for this call, Vadim. I'm the principal analyst over at dv01, and I help coordinate our research efforts and some of our third-party integrations. And I'm joined today with our senior product specialist, Chris Sullivan, as well as Rob Landauer from AD&Co, and who's the director of business development, and Daniel Swanson, who's the senior architect of the LoanDynamics model. Before we go further, I want to give a little overview of dv01. dv01 was started 5 years ago as our response to our founders' continued frustration with the inaccuracies, antiquated tooling, and lack of transparency that were so prevalent in structured credit during the global financial crisis. To that end, we're attempting to ensure this does not happen in our markets again by creating the first end-to-end data solution for the entire life cycle of underlying collateral, and that life cycle lasting from pre-purchase all the way to post-securitization. We have over 500 securitizations with nearly 3 trillion of notional and 21 million loans across virtually every consumer-facing assets. And in these assets, we provide solutions for data and validation, and analytics and reporting, and forecasting. And for a little more clarity of our offerings, for our pre-purchase product, we have an offering called Tape Cracker, which is a data wrangling tool that uses machine learning to effectively crack pre-purchase tapes. We have various surveillance offerings, both for existing market offerings in consumer loans, mortgages, small businesses, and student, to customize portfolio solutions for each individual needs of our clients. We also work with both buy side and sell side to intermediate credit facilities and ensure both accurate reporting and proper borrowing base, as well as eligibility criteria. And we allow access to the data in multiple ways, through either an data direct SFTP offering, a normalized database view, as well as our web app. And in all of this, we cover both portfolios and securitizations, where we provide both monthly reporting, forecasting ability, and all of the analytics we make available everywhere. And to that end, to make our product both more complete and enhance our offerings, we've made our platform seamlessly able to integrate with third-party data that can better infer what the outstanding universe of loans look like today, or what potentially forecasts could look like in the future. So today we'll be focusing specifically on the mortgage part of our offering, and we're proud to partner with Andrew Davidson & Co., who is making their LoanDynamics model available in dv01 architecture. The way we think about it, dv01 enables all stakeholders to properly view and run forecasts in the future, and those forecasts are much more accurate using the LoanDynamics model that Andrew Davidson has built. So with that in mind, I'm going to turn the call over to Rob Landauer, who's the Director of Business Development, to further illustrate exactly what LoanDynamics is. Rob, don't forget to unmute.
Okay, thanks very much, Vadim. This is Rob Landauer, and want to welcome everybody and thank dv01 for the opportunity to do this joint webinar today, and for the integration of our model onto their platform. So what I'm going to talk about today is a little bit about what LoanDynamics is all about. So what is LoanDynamics, or as we refer to it, LDM? So LDM is a reduced form roll rate model that provides forecasts of voluntary prepayments, defaults, and loss in a unified framework. And but by a unified framework, we mean that we strongly believe that competing risks need to be considered simultaneously. And the competing risks of voluntary prepayments and defaults need to be considered within a unified framework, because if you consider them separately, if you over forecast prepayments, you're going to under forecast defaults and vice versa. So we strongly believe that having a unified model where voluntary, involuntary, and loss severity forecasts are all within a unified framework is critical. The model generates loan level, life of loan forecasts that considers borrower and loan characteristics, as well as macroeconomic variables, including interest rates and home prices. The LDM suite currently consists of 4 different models. The first 2 are the 2 models that are available through the dv01 platform. First one is the model that we call the non-agency LoanDynamics model, which is a loan level, life of loan model for non-conforming loans like Jumbo Prime and the new Alt A, as well as securitizations backed by these types of loans like the legacy private label deals, MBS 2.0, 3.0, the non-QM deals, any securitization backed by these types of loans. And because they are loan level, life of loan, because this is a loan level, life of loan model with a severity or loss forecast, this model can be used for CCAR and CECL reporting, not only for securitizations, but also for your whole loan residential portfolio. So on the dv01 platform, you can actually upload your retained residential portfolio and use LDM for CCAR and CECL reporting. The second model on the dv01 platform is what we call our Agency LoanDynamics Plus model. And that's pretty much the same as the non-agency model, because it's a loan level, life of loan model for conforming loans and securitizations backed by conforming loans, such as the credit risk transfer type deals. And this model can also be used for CCAR and CECL reporting for conforming loans that you might have on your balance sheet. There are 2 other models that are not available, that are not currently available on the dv01 platform. First one is the Agency LoanDynamics Model, which is a pool level model for agency pools and CMOs. And then the Multifamily LoanDynamics Model, which is appropriate for the Ginnie Mae project type loans and bonds and the Fannie Mae DUS type bonds. So the first 2 are available on dv01. The third and fourth ones are not currently available. So why might you want to use LDM, or the LoanDynamics model? Well, LDM is widely used as a champion, benchmark, and challenger model by banks, mortgage banks, on the servicing side, on the origination side, asset managers, insurance companies, GSEs, and a variety of different regulators. LDM is currently used by several hundred clients. We have many clients that license the model directly from Andrew Davidson and Company, and many more that use LoanDynamics through our various wholesale relationships. There are a couple of ways that we keep the model viable. Because we have such a deep and varied client base, we constantly get feedback from our client base on the performance of the model. Because we've got such a wide and varied client base, and because the model is so integral to their reporting and their valuation, we constantly get feedback from our clients as to where they think the model is performing well and where they think the model might be missing. In addition to feedback from our clients, our modeling team is constantly surveilling the model to make sure that the actual versus forecasted performance of the model meets our internal criteria. In addition, because a big chunk of our client base are regulated clients like banks and insurance companies, they require in-depth documentation and online tools for their internal model validation, internal model risk management, as well as the requirements from the various regulators that regulate the various businesses that our clients are in. So we provide all of this documentation, white papers, online tools, access to our modelers to help answer as many of the questions we possibly can for the model validation and model risk management requirements. Our models are data-driven, so we look at historical data to calibrate and tune the model. Our data goes back, for some of our models, back to the 90s, definitely through the mortgage crisis, and we constantly add new data to the model to help us with the calibration and tuning. In addition, the COVID-19 data is data we're looking at very carefully now to determine how that will impact the performance of the model. In addition to using historical data to calibrate and tune the model, we'll also temper the model to ensure the model is generating results that make sense under a variety of scenarios and is reasonably consistent with the market's view of prepayments and defaults. We don't want to be an extreme outlier to what the market is saying about prepayments and defaults. We have our view, but we want to make sure it's somewhat consistent with what the market is saying. This next slide, LDM transitions, kind of summarizes our approach to modeling prepayments, defaults, and loss severity. As I said earlier, LDM is a reduced form low rate model and is a transition model. So as you can see in this first column, in this left-hand side, there are 3 different active states. There's a current state, which means loans are 0 to 59 days past due. There's a delinquent state, which means loans are 60 to 179 days past due. And then there's a seriously delinquent state, which means loans are 180 days or more past due. In this next column, there are the terminated states. There's a terminated state for voluntary prepayments, and then there's a terminated state for defaults or involuntary terminations. And then for every loan that terminates as a default, we're going to calculate the amount of that loan that can be recovered, which is primarily a function of LTV at the time of termination. And then we'll also calculate the loss or loss severity. So basically what the model is doing each month in time is forecasting the probability of a loan, let's say in the current state, remaining in the current state, transitioning to the delinquent state if the borrower starts to experience some distress like unemployment or some sort of life event, or that loan could transition to a voluntary prepayment. Notice that once a loan is delinquent, there are several things that can happen. That loan can remain delinquent. It could cure and become current again, but we'll consider that loan that was previously delinquent, but then becomes current because of curing. We'll consider that loan a blemished current loan. And blemished current loans have a much higher propensity to become delinquent again, but that propensity will burn out over time. And finally, or another thing that could happen is that a delinquent loan, if the borrower continues to experience distress, could transition to the seriously delinquent bucket. And once a loan is seriously delinquent, for the most part, it's a matter of how long is it going to take for the lender to get that loan fully foreclosed and off its books. So one of the key drivers of the seriously delinquent to the terminated or default transition will be whether it's coming from a judicial or non-judicial foreclosure state. And that will be a significant driver of how long it will take, how long it will remain in that seriously delinquent bucket before it will fully be foreclosed and off the borrower's books. And then for every loan that terminates as a default, again, we'll calculate a recovery and a loss severity. So this schematic we could talk a lot more about, but I think it fairly succinctly summarizes how the LoanDynamics model works. Next slide, we're going to talk a little bit about the inputs into the model. So there are loan level characteristics like loan type. Is it jumbo prime? Is it Alt-A? What's the loan size? What's the original and current LTV? What's the loan purpose? And were there any previous delinquencies? And if there were, how long ago was that delinquency? There are borrower characteristics like original FICO. How much documentation did the borrower provide? What state does the borrower live in? Then there are macro variables like interest rates and home prices, and then unemployment. So currently in the version,
sorry, I'm having trouble hearing you.
Oh, sorry. Currently, unemployment in the version that's on dv01, we account for unemployment through what we call residual tuning. So we know that some of the impact of unemployment is going to be captured by interest rates and home prices. So what we want to try and do is capture the amount of, or the unemployment, the impact of unemployment that's not already considered by interest rates and home prices. So by residual tuning, we mean that we're going to adjust this current to delinquent transition up or down, depending on what the unemployment forecast is, to capture the impact of unemployment that's not already considered or captured by interest rates and home prices. In the next version of LoanDynamics that will be released in the coming months, unemployment will be considered endogenously by the model, just like interest rates and home prices are currently endogenous to the model. The outputs from the model are a monthly vector of loan level forecasts of CRR, which are voluntary prepayments, CDR, which are defaults, and if you add CRR and CDR together, you get CPR, which are total terminations. We also have a forecast of delinquency and a forecast of loss severity. And as Chris is going to show in the next part of this presentation, these vectors are fed into the dv01 cash flow engine to provide prepayment and loss adjusted cash flows. Finally, let's talk a little bit about what the Andrew Davidson and Company offering is on dv01. So we're going to provide free access to the LoanDynamics model through September 30th of 2020 to try and gauge the interest of our mutual clients that are utilizing this free trial. During the trial, we're going to interact with as many of the users as possible to understand the various use cases you're interested in seeing, some enhancements you'd like to see of the offering, and start to define some commercial terms once the trial ends for continued access to the model. During the trial, we welcome feedback, comments, and suggestions as to how we can improve the offering, how we can improve the interface, and what other analytics you'd like to see. And again, please don't hesitate to reach out to dv01 or to Andrew Davidson and Company for more information. Okay.
Thanks, Rob. Before I turn the call over to Chris, I noticed a lot of you have already started asking questions, which is great. We're going to do a full Q&A at the end. If you do want to ask a question, please use the Q&A feature at the bottom of the Zoom, and we will address all of them once Chris is done with the presentation. And I'll now turn the call over to Chris for a demo of the product.
Great. Thanks, Vadim and Rob. Good afternoon, everybody. At dv01, we've worked hard to be the source of truth for various asset classes, and we continue to focus on providing data integrity as a trusted partner for all our clients. Our recent COVID research exemplifies our dedication, as does our web app, which I'll present here now. To demonstrate dv01 functionality, I've gone ahead and selected a non-QM securitization, Arroyo 19.2, and also incorporate our recently released non-QM benchmark. We'll examine collateral composition, performance, and utilize the AD&Co prepayment model to forecast performance, all within the sleek dv01 interface, displaying instantaneous response time on loan level data queries, resulting in investors and issuers both having greater transparency into loan level collateral composition and performance. Currently reviewing our overview page, displaying an OC chart, triggers, where we can toggle between cum net loss and delinquency triggers, and also our deal detail, complete with tranche info and collateral waterfall. Next, we can navigate to the documents page, where if we click on a hyperlink, it will download that period's remit to our PC without having to navigate to the trustee website. We also have the offering memorandum and rating agency report hyperlinked here as well. Now, to familiarize ourselves with the collateral composition, users can utilize the Strats tab. We can edit columns to select various fields in order to our preference, as well as toggle primary attributes with the option to include secondary and tertiary strats to perform more granular analysis. By going into our dropdown, we can select from the various fields available, and they will append to the bottom of our strat table page. Additionally, we can edit our buckets to allow for customized groupings of all the numeric fields. I really recommend saving a view to quickly select during future use, and that will allow us to export to PDF and Excel in a consistent format. After getting ourselves comfortable with the collateral composition via strats, we can navigate to performance. Historical performance is a page we recently revamped and are really proud of the functionality. And previously, it functioned as a table summary of remittance information with tranche information and a few charts depicting DQs, prepays, and defaults. Our new features include the ability to view and select multiple deals simultaneously, and we can do so across shelves. So by clicking the compare button, they'll prompt our pool selector, and from here, we can add various other securitizations using the search bar. So why don't we go ahead and pick a few from various shelves. To check out this functionality. From here, we can select various performance attributes and columns to include in our table. Let's say I'm particularly interested in voluntary prepayments, current coupon, updated LTV, and delinquency information. We can collapse our pool info and now have all that information summarized remit period by remit period for each of these three securitizations. As we scroll down, we'll notice the recent uptick in delinquencies for the GCAT and Arroyo deal, helping us be able to quickly analyze and compare performance across these securitizations in a nice, sleek interface. Next, we can go to historical analysis. We can create time series charts utilizing a wide range of performance metrics to choose from. As you can see in this dropdown, we have the traditional performance metrics of CPR, CDR, rolling average of both, delinquencies, some cumulative performance metrics to choose from, as well as some others such as returns and some statuses and modification information. Suppose we're interested in examining CPRs, but we want to strap by servicer. We can quickly apply that attribute and smooth out some of this performance utilizing the 6-month rolling CPR, and quickly be able to analyze which servicers have historically serviced in a faster fashion compared to others. Vadim recently did some research in our COVID performance volume 5 piece around the percent impaired metric, which includes delinquent and modified loans. And we can view that performance information stratted by a doc type. Doc type is an essential data field for non-QM in our minds, and we've done the painstaking work of already standardizing this information for you. Additionally, we can also add in our non-QM benchmark. I think. There we go. We'll apply that as a pool step. And now we can analyze impairment of the larger non-QM universe. Below our chart is also a table providing all this data. Alternatively, we can investigate the 30+ delinquencies for the Arroyo deal and compare it to the delinquencies of the benchmark by utilizing the pool strat. We can also filter down these data sets by using the filters at the top. Perhaps we're mostly interested in the last 3 or so years of collateral. We can filter by 2017 and later vintages. And now because dv01 works at the loan level, we can also normalize all these performance data points by loan age. So here we can now examine the 30+ delinquencies for both data sets across WALA. Additionally, we could also go back to our more standard 1-month CPRs to see how voluntary prepayments have performed as the collateral seasons. Also within our performance tab is the transition matrix, where we can view by notional, percentage, or loan count views, and assess the likelihood of loans transitioning and moving between loan statuses for a given remit period. Moving out of performance, we have our loan tape page. This is a good place for me to highlight our other third-party integration of House Canary. As you'll see in the top header bar, we have the Powered by House Canary 56% updated LTV. In addition, we have the House Canary 1-year HPA values and HPI updated LTV presented at the loan level on this table. We can continue to utilize the ability to filter. Perhaps we want to filter down by loan status and assess some of the more delinquent stages. By clicking on a loan ID, it will populate the loan ID card, summarizing the borrower and loan information associated with that loan ID. We have a nice pay string visualization, as well as all the data presented in a nice interface. Lastly, within the loan tape page is the ability to export a loan tape, where we can export via a loan tape template, which will essentially be a save format, including customized field names, which fields are included, and also the drag and drop ordering functionality. And now the moment we've all been waiting for, cash flows. Our new users will be greeted with a disclaimer when navigating the cash flows for the first time, so don't be alarmed. As you can see, when we land on this page, the AD&Co model automatically loads. Additionally, we can create custom scenarios. We can also utilize the functionality of reflecting from a save scenario. One thing I like to highlight with our cash flow engine is the ability to incorporate steps, ramps, and other notation styles as we have with defaults. In this case, it would be a 1 CDR assumption for 6 months, and then going from 1 to 1.5 over the next 12 and a quarter CDR tail speed. For prepays, I use the AO notation style for anchor or ridge, which essentially assigns the appropriate CPR value based on the underlying loan wallet. Additionally, we can copy the AD&Co scenario and we'll give it a name. We'll call this AD&Co stress. And what we can do here now is apply multiples to our prepay and loss curves. Let's say we want to run prepayments half as fast and losses at a 3 times multiple. We can do that. And now when we click run cash flows, this cash flow engine will run at the loan level, all 2,290 loans for 3 different scenarios, and do so pretty quickly. Displaying an output of the capital stack that we can toggle various views from, including tranche level views. We can download deal cash flows, and we'll have a few charts depicting cum net losses and prepayments and a collateral cash flow summary. There we go. So perhaps as an investor, I'm particularly interested in the M1 class. I can toggle the tranche view, locate my M1, and perform a spread lock of 350 to the curve, and see the resulting dollar price output, measuring the price sensitivity of that bond across our various scenarios. We have duration metrics included here as well. And as I mentioned, a collateral cash flow summary, some charts depicting our cumulative prepays, and also our cum net loss across our various scenarios. And what I really like about this is the inclusion of the trigger values defined in the deal docs. And then lastly, a collateral cash flow summary at the bottom. Please reach out to sales@dv01.co for more info and to schedule an additional meeting for further detail on offerings and services. I'll now hand it back over to Vadim. Thank you very much.
Thanks, Chris. And everyone, thank you for listening to our webinar. For any further information, please contact our sales team. And now we'll go to our question section. So we've got a few in line, and I'm just going to manage these for individual people. First question is, are the cash flows from LoanDynamics on dv01 at the loan level? I'll take that one. The answer is yes, everything is on loan level, and we can drill into our cash flows to express that on a loan level basis through our cohorting, where you can run specific pools at the cohort level. So if you wanted to do a non-QM deal where you just wanted to look at the cash flows for just the self-employed loans or just low FICO loans, you can do that, and all of those cash flows would be loan level, fully integrated with the LDM model. Second question is for Rob or Daniel. Will AD&Co provide any additional analytics like OAS or home price forecasts on the dv01 platform?
I could take that one, Vadim. Yeah, that's all very possible. We're happy to work with dv01 to provide some of our financial engineering tools like OAS, our home price simulation model, and other valuation and credit surveillance tools that we've developed. We wanted to start with kind of our flagship product, which is LoanDynamics, and then based on feedback from those that are trialing LDM on the platform and feedback on some of the use cases that you would like to see, that will prompt AD&Co and dv01 to work on the integration of some of our other financial engineering tools and analytics.
Cool. Next question, will dv01 be able to provide back testing for AD&Co's performance on MBS 2.0 like JPMMT deals? Great question. in terms of any deal that lives in the dv01 architecture will have full access to the AD&Co model. If it's non-QM, if it's CRT, if it's portfolios, as we had, as we discussed earlier, and that of course includes the prime jumbo deals like Jake MMT. For specific back testing and validation, it's something I think, Rob, do you want to take a stab at whether we would want to do back testing for some of those deals?
Like to kind of show how well the model did, actual versus forecasted historically on the dv01 platform. Yeah, I think that's something we can definitely work with dv01 to build out that capability as well.
Awesome. I'll get to this one. So what are the differences in functionality between dv01 and Intex? I would say, so what's very clear here is we will touch the loan platforms, we will touch mortgage loans far earlier with far more collateral granularity than what Intex is doing. Because of our tape cracker offering, people can actually start looking at loans before they even purchase them through standardized loan tapes and normalized kind of data pipelines and analytics. Furthermore, in our model, everything that lives in our web app exists fundamentally at the loan level and works up. So everything that you're interacting with, whether it's our strats pages, whether it's our performance pages, they're specifically built to be able to fully analyze that pool of loans from every level of granularity and be able to do a seamless comparison over time. As you saw Chris do in the web app demo, you can quickly grab a pool, look at its attributes, and compare it to any sort of benchmark you want. We have the ability to grab all 45 CAS all 50 or so CAS securitizations, or all 40 or so, or almost 50 stacker securitizations, and compare them alongside one another in a matter of a minute or two, which is not something that is streamlessly available through other functionality. And you can compare both historical performance and strats. So there's a full-fledged analytics reporting feature that we have that kind of goes well before we start thinking about the cash flow forecasting side. And the other thing we're doing is we're also doing validation against not only the data that we're putting out, but we're also validating against third-party reporting like trustee reports and like the information that's available on the trustee site. And we're validating to ensure all manner of data accuracy, both for static information available at early loan tapes, as well as dynamic information such as that updated in the trustee report. And then finally, we're fully integrated to be able to do not just the securitized market, but we're also able to fully integrate with private portfolios and credit facilities. So we're able to fully encompass the entire workflow of a mortgage loan, regardless of what status it sits in. Next question, do you plan to, actually, let's go to the LDM one. If a client is currently using LDM through another system, like portfolio management solution, will that be taken into consideration in a licensing fee to use LDM on dv01?
Yeah, I could take that one, Vadim. Yeah, so I think as all the AD&Co clients will know, we provide, we're always anxious to have our clients use our model through multiple platforms. So if a client is already using the LoanDynamics model through another system and they are interested in using it on the dv01 platform, we do provide an add-on fee. We do have a license fee that is an add-on fee that's lower than the initial use case. So we do try and encourage the use of our model across multiple platforms, and we encourage that through our license fees.
There was a question about contact information at dv01, and that's a great question. It's sales@dv01.co. Yeah, so please contact us there, and we'll absolutely get a response out very quickly. Chris makes sure that all of our response times are rapid. That is, and then the last question we have is, does dv01 plan to add other asset classes, example auto? Absolutely. We are always looking to expand asset classes. We have covered both the traditional asset classes and consumer-facing world, like unsecured mortgages and student loans, but we've also expanded our scope into more esoteric asset classes. We've done we've done online small business lending, but we've also done a lot of the emerging post-crisis assets, such as fix and flip loans, being more of a securitized products offering, as well as single-family rental assets. And in terms of auto, it is a sector that we're absolutely not just forecasting for the near future, but are already taking steps to integrate as we speak.
And interestingly, AD&Co is actually working on an auto model now. It's kind of going to be our first non-residential asset class that we're covering. So we hope to have that model out sometime this year. So when dv01 has some auto deals on their platform, that's another model we can think about adding to the mix. And finally, I'll just add my contact information. You can reach me at Rob, R-O-B, at AD&Co.com. Pretty straightforward.
And as well, contacts for myself and Chris are pretty simple. Vadim at dv01.co. And Chris, want to give yours?
Absolutely. Chris at dv01.co. Despite, quarantine kind of emerging, I'm still excited to talk to everybody. Looking forward to having a lot of conversations in the follow here. Don't hesitate to reach out to us.
Great. I'm showing no more questions. So once again, thank you so much to Andrew Davison for partnering with us on the call. And thank you all for joining us and for all your insights and questions. And please, again, don't hesitate to contact us for future dialogue.